This is Alpha. We continue to talk about the investment opportunities provided by market factors in the previous issue. Replacing emotional operations with standardized transactions, macro analysis of market factors. We have a general understanding of the various factors that affect the market. The impact of these factors on the market varies greatly in terms of time and depth. What we need to think about is to analyze the characteristics of these factors and try to find ways to earn certain returns from these characteristics. Due to my personal level of cognition, I only discuss this topic from the perspectives of market fluctuations and basic indicators that reflect emotions, hoping to be able to throw bricks and jade. Let's talk about opportunities and market fluctuations first. Opportunities and market fluctuations can be roughly divided into three categories. The first category is factors that are easily digested by the market immediately, such as the company's record financial reports and relatively certain macroeconomic data. This information is usually quickly digested and absorbed by the market after it is released, and the stock price will quickly adjust to the right place. In this case, it is difficult to grasp the opportunity to make a profit. The second category is factors that are not easily digested by the market immediately, such as long-term policy changes. For example, the U.S. tariff policy in 2025, the trend of industry changes, etc. The impact of these factors is gradual, with great uncertainty, and has a long-term trend impact. The market may take a long time to fully digest. These factors with long-term trend influence provide investors with some layout opportunities. The third category is factors that overreact to market sentiment. For example, market factors lead to overreaction to the market decline, which is significantly lower than the stock valuation with a large safety margin. At this time, we can take advantage of this opportunity to go long at a low level, which can be used as a long-term investment or as a short-term arbitrage. The following is a related case analysis. Case 1. Factors that are easily digested by the market immediately. Let's take Apple's first quarter 2023 financial report as an example. When Apple released its first quarter 2023 financial report, the financial report showed that the company's revenue was as high as $94.3 billion, exceeding market expectations, and earnings per share were also strong. After the financial report was released, Apple's stock price rose rapidly by about 5% in after-hours trading, and continued to rise after the opening of the next day, and finally closed up 7%. This event shows that the market digests certainty, such as financial report information, very quickly, leaving almost no room for investors to make excess returns. For ordinary investors, if they want to profit from such news, they often need to make arrangements in advance, and there is no chance to chase the rise after the news is announced. Case 2. Factors that are not easily digested by the market immediately. On March 26, 2025, the U.S. government announced a 25% tariff on all imported cars and their parts. This policy aims to protect domestic manufacturing, but it has caused market concerns about the global supply chain and trade pattern. However, what is inconsistent with this information is that the impact of this policy is not immediately reflected in the stock price. Take the manufacturing industry as an example. Companies that rely on imported raw materials, such as some automakers, have gradually fallen in stock prices in the months after the policy was announced, and they did not fall all at once. Domestic substitute manufacturers, such as some suppliers of Tesla, have gradually been favored by funds. This slow trend change provides investors with layout opportunities. By deeply studying the impact of policies on different industries, investors can adjust their investment portfolios to obtain long-term returns before the market fully digests the impact of policies. Case 3. An example of overreflection of market sentiment. The case is Bill Ackman's operation in the decline of U.S. stocks during the outbreak of the new crown. In March 2020, the global outbreak of the new crown epidemic caused market panic to heat up rapidly. U.S. stocks experienced violent fluctuations, and the S&P 500 index fell by more than 30% in just a few weeks. The stock prices of many high-quality companies were also dragged down by panic selling. At this time, Bill Ackman, a famous hedge fund manager, quickly captured this opportunity. He first shorted the market by purchasing credit default swaps, CDS, and made a profit of about $2.6 billion in the market decline. Later, he judged that market sentiment was overly pessimistic and quickly turned to long positions at the end of March, buying stocks such as Starbucks and Hilton. As the market gradually stabilized, his investment portfolio achieved high returns in the subsequent rebound. This case vividly shows how to take advantage of the overreaction of market sentiment and go long at low levels to obtain high returns. Let's talk about the opportunities of technical indicators in the calm market in the emotional aspect. In the last issue, we talked about that technical indicators are more of an emotion than a technology. When there is no major event, pay attention. This is the most important premise. At this time, the fluctuation range of market sentiment is relatively stable. Technical analysis can reflect the fluctuation of investor sentiment, similar to the reciprocating motion of a pendulum. At this time, there may be opportunities for speculation, such as rebound after overbought and oversold, trend-following operations when the trend continues, etc., which can be captured through technical indicators. Next, let's use cases to experience the opportunities brought by technical indicators. Case 1. Rebound after overbought and oversold, the application of RSI indicator on Tesla stock. In June 2023, Tesla's stock price continued to rise driven by the new energy vehicle boom, and the relative strength index RSI broke through 70 and entered the overbought range. Experienced traders noticed this signal and predicted that the stock price might pull back in the short term. In the following days, Tesla's stock price fell back by 10% and RSI also dropped to around 50. Some speculators took advantage of this opportunity to reduce their positions at high levels to avoid losses, and then re-established positions in the subsequent pullback to capture short-term gains brought by the rebound. This case shows that in a calm market, technical indicators such as RSI can effectively help investors identify opportunities in short-term trading. Case 2. Trend-following operations when the trend continues. The application of the moving average system in Amazon stock. In 2023, Amazon stock showed a stable upward trend driven by its e-commerce business and cloud computing business. The stock price continued to run above the 200-day moving average, and rebounded quickly every time it pulled back to the vicinity of the moving average. Technical investors observed this trend and adopted a trend-following strategy. When the stock price pulled back to 200, buy at the daily moving average and profit from the continuation of the trend. In August 2023, Amazon's stock price rose 15% after hitting the 200-day moving average, bringing considerable returns to investors. These cases show that in a calm market, the moving average system can help investors seize some trending opportunities. Case 3. This is a negative case. The technical indicator signal failed in Meta stock in 2022. In 2022, Meta's stock price showed buying signals many times on the technical side. For example, the MACD indicator had a golden cross in the middle of the year, suggesting that the stock price may rise further. However, the actual situation is quite the opposite. Due to the huge investment in the metaverse project that is difficult to see returns in the short term, and the decline in advertising revenue due to the economic slowdown, the company's fundamentals continued to deteriorate, and the stock price fell nearly 50% all the way. Due to the purchase brought by technical signals, it suffered huge losses. This case reminds the limitations of technical analysis. When there are major changes in fundamentals, technical indicators are likely to fail. Remind us again. A prerequisite for the use of technical indicators is that other more important market factors have not changed significantly. If investors rely only on technical aspects and ignore the analysis of other macro factors, they are likely to make misjudgments. Let's make a simple summary. Through the above cases, we can see the practical application of market fluctuations and technical aspects in investment. The opportunities in market fluctuations require investors to keenly capture real-time information and policy trends, while technical aspects provide effective tools for short-term speculation in a calm market. However, technical analysis is not omnipotent, especially when the fundamentals have changed significantly. Its role may be greatly reduced. Therefore, investors should combine technical aspects with other macro factors for comprehensive consideration. formulate trading strategies from a more comprehensive perspective, and flexibly apply knowledge of market fluctuations and technical aspects in a complex and changing market environment. Not only can it help us avoid risks, but also find ways to earn certain returns. I hope these cases and analysis methods can inspire you to explore the mysteries of investment together. Okay, let's stop here. We will continue in the next issue.